Good evening, ladies and gentlemen. We'll begin the webinar in a short time to allow more participants to join in within these last few minutes. I would also like to flag everyone that you can join with us with the Zoom link, that is if you are a registered participant, or you can join via our Facebook Live by just visiting Office Capital Facebook page. We'll come back in a moment.
world is speeding up, and Sri Lanka is progressing with it. Succeeding in this time requires innovative strategies and a performance-driven mindset. For over 35 years, First Capital has put performance first in everything we do. We have optimized every aspect of our operation to deliver the highest performance and results to our stakeholders. As we march into the future, we are committing to elevating our services even further, moving forward with what we believe in to provide you with a premium service, delivering on our promises, finding the best solutions for our clients, going above and beyond to deliver value, and upholding the highest levels of professionalism. Rest assured, every step of the way, we will deliver performance first in everything we do. First Capital, performance first, always.
Good evening, ladies and gentlemen. On behalf of First Capital, I warmly welcome you all today for our 6th Economic Forum. During this webinar, we'll take you through our Investment Strategy 2022, along with a presentation of the apparel and textile sector. An investment in knowledge pays the best interest. A famous quote by Benjamin Franklin, which says, when it comes to investing, nothing will pay off more than educating yourself. So for that, do the necessary research and analysis before making any investment decision. We believe that our forum today will help you to get a detailed look at the bigger picture before your decisions. This webinar is lined up with 2 segments. During the first half, we will take you through our Investment Strategy 2022, followed by a panel discussion with 2 renowned economists in the country. During the second half, we'll take you through a presentation on apparel and textile sector, followed by a panel discussion with the industry experts. I would also like to remind the audience that you can post your questions on the Q&A section of the Zoom app, or if you're joining via our Facebook Live, you can post your questions in the comment section. Without keep you waiting anymore, let's straight away dive into the presentation of our Investment Strategy 2022, conducted by Dimantha Matthew and Hiruni Pereira. Dimantha, over to you.
Thank you, Vidushika. Let me share my presentation. Good evening, ladies and gentlemen. It is no secret that Sri Lanka is today in a sort of a bother and a crisis. So let me start off with a quote by Maxwell Maltz. A close scrutiny will show that most crisis situations are opportunities, either to advance or stay where you are. So basically, it is important to understand where exactly we are in the crisis. It's because a crisis itself, as the quote says, can become an opportunity. So that is what we are trying to emphasize in this presentation. So the theme for the evening is time is running out. So let's dig deep to understand as to why the time is running out and what for is the time is running out. So this presentation will be of 3 parts. First, we will be looking at what First Capital has recommended over the past 1 year. And then let's look at what the factors are that are important for 2022. And finally, we will go into the recommendations section. So starting off, these are the levels of accuracy that I'll be using during the track record section. So looking at the bonds section, basically in January, we have been iterating that bond yields are likely to gradually trend upwards from the first quarter onwards, and we were looking at 150 to 200 basis points upside during the first half of the year. So basically, we've been broadly accurate there. And if you look at during our mid-year outlook, we were expecting a further 150 to 200 basis points during the next 4 quarters. However, though the targets were reached, the base and the direction was sort of accurate, the rising yields were way sharper than we expected. So we also expected a acceleration in the rise in yields, but the rise was sharper than what we initially anticipated. Looking at the first 8 months, we saw you can see that the 1-year yield was sort of lagging behind. But if you look at the last 4 months, you can see the overall yield curve significantly moving up by around 200 to 250 basis points. If you look at the policy rates, so during the first half of the year, we were not expecting any change in policy, but in the second half of the year, we were looking at 2 rate hikes. However, we saw only 1 rate hike on the 18th of August. However, it was a big one. Not only did they increase policy rates by 50 basis points, the SRR was also increased by 200 basis points. Then if you look at the first half of this year, we were looking at 2 rate hikes again, and we have already received 1 rate hike on the 19th of January. So we would identify this, our recommendation, as mostly accurate here. In terms of AWPR, here also we believe that we've been mostly accurate. So our target was around 7.5% to 9%. So at the start of the year, we were expecting a rather slow uptrend of the AWPR, but that was not to be. But during the second half, we saw a significant rise in the AWPR, and though our target range was reached, basically it was reached 6 months in advance. So we would identify it as mostly accurate. In terms of the exchange rate, we were looking at the exchange rate being floated, but it's tightly controlled. So basically, we would identify it as inaccurate. In terms of equity, though we had a couple of upgrades during the year, you can see during the last 4 months, there was a significant acceleration in the index, and the index by January exceeded the 13,000 mark as well. So our accuracy levels were quite weak in this area. Let's straight away go into the factors that need to be considered. So our theme again is time. The time is running out. So our foreign reserves are sort of draining, and there's a lot of debt piling up, and also we have a significant amount of repayments to be made. So we need to act fast. We need to look at solutions to solve this problem at hand. IMF support is one, possibly debt restructuring is something that we need to look at in order to get through this crisis. But we don't have sufficient time, and the government or the central bank doesn't seem to be acting fast enough to solve the problem. So therefore, it's important to remember that for Sri Lanka now, the time is running out. So these are the factors that we want to take you through during the presentation. So I will straight away go into the policy section. We believe that the policy stability is deteriorating. However, we are maintaining the risk level as medium low. We downgraded it during our September mid-year outlook. And so let's look at the election situation. So local government elections, as we predicted during our September report, the local government elections were postponed by around 1 year. So the elections are likely to be held now on the 19th of March 2023. However, the interesting factor is the provincial council elections. So as you know, with the economic struggle, India seems to be getting a bit more closer towards Sri Lanka. So India is supporting through credit lines and currency swaps. And also we know that they've managed to push Sri Lanka to come into negotiations with the in relation to the Trincomalee oil tank, which is a deal that was stalled for almost 30 years, starting off in the 1980s. And also another thing that we are forecasting is that with all this pressure, we believe that there could be some push towards from India that we may be pushed towards provincial council elections. As you know, North and East provincial councils were pushed by India previously as well. So basically, we have an expectation that there could be provincial councils elections around the fourth quarter of this year. So the cabinet reshuffle or the new finance minister didn't really solve the popularity issue in the government, and also they are seeing a weakness in the decision-making process. If you look at the first half, we saw many issues like the delay in importing vaccinations, the fertilizer ban, the teacher salaries, and so on. So, but more recently, we are seeing the gas explosions, the fuel shortage, gas shortage, the significant food inflation, and then most importantly, the power cuts that are coming. So basically, this has left the government with no answers, and basically there seems to be some sort of delay in basically taking decisions, and the forex crisis is taking a toll on the government. So with all this, there seems to be some sort of instability coming into the system now. So we maintain our outlook at medium low risk. So to take you through the economic outlook, I would like to hand over proceedings to Hiruni. Hiruni, over to you.
Yeah, thank you, Dimanta. Let me share my screen first. Yeah, so let me take you through the economic factors. So as mentioned in the previous strategy report, we have maintained high risk for the economic factors. So as you can see, some of the key indicators in the economy has risen. So inflation has recorded 13-year high, and it has recorded 12.2% in December 2021. And we expect in 2022, inflation to peak at 14.4% by mid of the year amidst a higher base effect. So as you can see in your right hand side, some of the key commodities have seen increase in their prices. So for an example, cement with multiple hikes, it has increased up to 1,375, and gas has increased up to 2,675. But issue is, even at these price levels, you can't find some of these commodities in the market reflecting the higher inflation in the economy. And moving on to GDP, another key barometer of the economy. So we know in third quarter 2021, we recorded a negative GDP growth of 1.5%, but with the gradual recovery in economic activities, we expect GDP growth to record 3.6%. So altogether, our GDP growth expectation for 2021 is 4%. So when you move on to 2022, there will be a GDP growth in terms of the nominal terms, but inflation is likely to take a toll on the real GDP growth, as well as interest rates and the heavy depreciation are negatively impacting on the GDP. So a targeted range of GDP growth for 2022 is 0.5% to negative 1.6%. However, in 2023, we expect Sri Lanka to start a recovery process. Probably Sri Lanka might move on to some sort of an IMF program or self-induced debt restructuring program. So with that, our GDP growth target is in the range of 2% to 2.5%. And moving on to the private sector credit. So we know in 2020, private sector credit took a dip and recorded a growth of only 6.4% due to the impact of COVID-19. But with the aid of the historically low interest rates environment in 2021, private sector credit recovered and recorded 12.1% up to November. And our target for the full year of 2021 is 13.5%. However, with the gradual rise in interest rates environment, we expect private sector credit to gradually slow down and record only 10% growth for 2022. So moving into the global context, we know inspired by the modern monetary theory, a lot of central banks introduced easing techniques after the COVID-19 pandemic. However, after realizing the negative impact of the inflation, they have started to introduce tightening techniques and they have halted the money printing. So can Sri Lanka follow suit with no money printing? Let's look at it. So we know Sri Lanka's liquidity in the system has completely dried up, and this has started, the negative liquidity has started when CBSL introduced the statutory reserve requirement hike from 2% to 4% in August 2021. And from there onwards, the liquidity has started to record negative, and it has recorded somewhere close to 450 billion by January 2022. And on the other hand, CBSL holdings started to keep climbing up. And in January 21, it recorded only 736 billion. And within about a year, it has even more than doubled and recorded somewhere close to 1.5 trillion because the CBSL find it difficult to borrow at the current rates. However, on the other hand, the private sector credit has increased in competition to the government borrowings with the aid of historical low interest rates. So it has dipped in September, but with the increasing in the economic activities, it has recorded 60 billion by November. But we expect this to gradually slow down with the rising interest rates. So you can see AWPR has increased by 80 basis points during third quarter, and it has increased by about 215 basis points in fourth quarter 2021. So this is going to impact on the private sector credit in 2022. And moving on to the external side of things, we know that export-import activity of the economy has recovered. So export activities has recovered and recorded above 1 billion mark for the 5 consecutive months. And also, on the other hand, the import expenditure has also increased with the depreciation of the rupee and also with the rise in raw materials and the commodity prices in the market. So we expect this trend to continue in 2022 as well. So therefore, we expect trade deficit in 2020 to widen up to 8.8 billion. However, there's a silver lining in the economy. So that is the gradual recovery in the tourist arrival. So in 2021, we have recorded somewhere close to 194,000 tourist arrivals. So that even beat our previous estimates. And we expect this trend to continue and record a gradual growth in the tourist arrivals. And when it comes to earnings, you can see compared to the arrivals, the earnings number is relatively smaller in 2021, but we expect this to gradually improve and reach 5 billion by 2024. And moving on to the worker remittances. So we know worker remittances took a hit and recorded 10-year low in 2021. And so it only amounted to 5.5 billion. But we expect worker remittances to gradually improve in 2022 and record 6.7 billion with the gradual depreciation of the currency. And moving on to the balance of payment. So in 2021, we expect balance of payment deficit to record 2.5 billion, but with the significant debt repayments and with the widening trade deficit, we expect in 2022 balance of payment to increase up to 4.2 billion. So we have identified these as a crisis scenario. But if Sri Lanka materializes the expected inflows, we expect this balance of payment deficit to reduce up to 2.2 billion. So balance of payment is only one part of the problem, but there are other problems that the government need to manage. So one such problem is the budget deficit. So in 2020, we have recorded a double-digit budget deficit of 11.1% with the increased government expenditure. And in 2021 also, we expect this to record 10.1%. And in 2022 also, this trend is continue and expect to record a budget deficit somewhere close to 10%. So this has resulted in higher borrowings by the government. So that has reached 17 trillion by September 2021. And you can see that majority of these borrowings comprises of the domestic debt. So moving on to the foreign reserves. So we have identified some of the transitory borrowing options that will provide a lifeline to the economy. So we have identified a few of them here. So this include about $900 million swap facility by India. And out of this 900 million, we have already received the 400 million. And also there will be another 500 million US dollar deferment in terms of the Asian clearing unit. And also currently we are in the discussion with the government of Qatar for a sub facility of $500 million. And also there's a pending credit facility from India by about $1.5 million. Another possible loan from China and a possible relief package or rather credit line from Japan amounting to $2 billion to 3.5 billion. So all these foreign inflows add up to 6.4 billion. But what we need to remember is some of these credit lines have some conditions attached or imposed by them. So whether we will actually materialize those inflows within the given stipulated timeline is somewhat questionable. So moving on to the foreign reserves. So, so foreign reserves is like walking on a tight rope. So we know in 2021, we end the year with the foreign reserves amounting to 3.1 billion. So here we have basically identified two scenarios. So in the first scenario, we have assumed that Sri Lanka will receive the expected inflows. So with that, we will close the year with a $1 billion foreign reserves. But in scenario 2, we have assumed that Sri Lanka will not materialize the expected inflows. So even by somewhere like October, we will record near zero foreign reserves. And we have identified this situation as a crisis scenario. So to talk about the Forex crisis scenario, I will hand over the proceeding to Dimanta. Dimanta, over to you.
Thank you. Thank you, Hirni. So I will share my screen. Yes. So talking about the Forex crisis that we are having at the moment. So we have a large amount of repercussions already being materialized. So if you look at the hotel and restaurant sector, we are seeing a shortage of cooking gas. So we are seeing foreign missions being shut down. We have problems in the airline operations, T section is having problems, essential food importation is having issues, and most importantly, CPC and CEB is having problems, possibly leading to power cuts. So as you can see across the board, we are seeing problems in every sector due to this Forex crisis already being materialized. So if you look at the situation now, we've talked about the BOP deficit, then we talked about the high budget deficit. In addition to that, something quite important for us to understand is the debt maturities. Now, debt obligations are continuing to rise. Here in the chart, we have only the bond obligations. We've not been able to get the data for the project loans. So even that, if you can see 2021 compared to 2022, you can see in the year 2022, we are having a 24% rise in terms of the bond repayment. So 1.2 trillion in terms of Sri Lankan rupees is the amount that we have to repay here. And what's more important out of that is the foreign debt component. So overall foreign debt, foreign currency repayments during the year amounts to 6.6 billion US dollars now. And if you look at the breakdown over the current 2 months, we have about $1.4 billion to be repaid with the ISB of $500 million, which we already repaid last week. But more importantly, from the 4th month to the 12th month, we have $5.3 billion to be repaid. And more importantly, we have a $1 billion sovereign in the month of July to repay. So with the foreign reserves at pretty low levels, the foreign reserve cover is declining pretty fast. So almost the foreign reserves are half of the debt obligations that we have to pay in terms of foreign currency. So with that risk, we are seeing a significant increase in the demand for treasury bills. So you can say out of the overall bills and bond portfolio, now treasury bills amount to 26%. And you can see the surge happening from starting from December 2019, from 900 billion rupees up to December 2021 of 2.4 trillion rupees at the moment. So with that, you can say out of the 3 quarters in this year, so out of the 4 quarters, 3 quarters, we are having a significant amount of pressure during the 1st quarter, and the 3rd quarter, we have a lot of foreign currency debt repayments. However, in the 4th quarter, it's mostly rupee repayments that we have. So a lot of negatives in the economy, but the only positive and the silver line, as Sirni explained, is the recovery in tourism. And so the summary is that economic outlook is at high risk level at the moment. So to take you through the external outlook, I would like to hand over proceedings to Hirni. Hirni, over to you.
Yeah, thank you, Dimanta. Let me share the screen again. Yeah, so let me elaborate on the external outlook. So for external outlook, also we have maintained high risk. So one of the major reason is we had downgrade by all 3 rating agencies. So Fitch downgraded us to CC, and Moody's downgraded us to Caa2, and S&P downgraded us to CCC. On the other hand, the global central banks are moving towards a hawkish path. So you all can see that global monetary policy rate has seen a gradual increase. And also Fed is now is in a kind of tightening scenario. So earlier Goldman Sachs predicted 3 hikes for the year, but now they have increased that up to 4 times for the year. And also IMF is saying that emerging economies must prepare for the Fed policy tightening. So that because when the Fed increase the interest rates, the fund flows will be gradually moving to US. So that will affect the emerging economies with the currency depreciation. So Sri Lanka being one of the emerging economy will be at a disadvantage due to that. And also all IASB rates have moved beyond 20%. So that makes us difficult for us to raise funds in the international market. So if I summarize the external outlook, so as mentioned before, credit rating agencies have downgraded us. Fed is moving towards a tightening scenario, and ISB rates has moved up, making us difficult to raise funds in the market. So this makes the external outlook as high risk. So let's look at the outlook trend for Sri Lanka. So political, we have placed at medium low risk, economical at high risk, and external at high risk. So let's assess the macroeconomic criteria for our investment decision. So we basically use the priority criteria and the secondary criteria. So let's move on to the priority criteria. So these factors we have discussed before, and you can see almost all the priority criteria are currently at high risk. And moving on to the secondary criteria, again, most of the criteria are at high risk, except for the political risk and investor confidence, which is placed at medium low and medium high. So this directs us to find us a long-term solution. So at the moment, Cabinet on a couple of occasions have considered moving on to an IMF program, but they have so far rejected all the proposals, and even the governor is denying moving on to an IMF program. But considering the long-term issues that Sri Lanka is facing, First Capital believe that moving on to an IMF program or some sort of a debt restructuring program is of paramount importance. So therefore, we have assigned an 85% probability, considering that Sri Lanka may move on to an IMF program as soon as possible. So to talk about the recommendations, I will hand over the proceeding to Dimantha. Dimantha, over to you.
Thank you, Gavini. So let's quickly look at the recommendations that we have. Starting off with the bond market. So bond yields we expect will extend the upward trend. And so this is mainly because if you look at our fixed income health score, it has significantly declined, as you can see. But still we expect that there could be some sort of IMF support towards the third quarter or the fourth quarter. So we are basically bringing that in here into our forecast towards that period. During the first half of the year, we are looking at bond yields rising by around 150 to 200 basis points. And then during the second half, we are looking at 100 to 150 basis point rise. So basically at the end of the year, we are looking at 1 year at 10 half, 11 half, 5 year at 12 half, 13 half, and the 10 year at 13% and 14%. So in addition to that, we do have a crisis scenario also here, where which is in the pink boxes, where we've taken into account a no IMF, no inflows sort of scenario. But if you look at the year-end targets, I believe that even these rates look optimistic in such a scenario. So overall, base case is that we are looking at for 250 to 350 basis points during the year. And even our most optimistic scenario, which is 10%, also shows that we are looking at a slight increase in rates. So strongly bearish for bonds at the moment. In terms of policy rates, so we are looking at 3 policy rate hikes during the year, 2 in the first half and 1 in the second half. So lesser in terms of policy rate hikes compared to the rise in yields. This is mainly because there is sort of a deterrent in the central bank. If you look at the track record, that the central bank doesn't increase rates as much as the yields move up. So that is what we have seen in the past. So looking at the banking rates, so the banking rates will follow the 5-year bond, but obviously with about a 4 to 6 month lag. So we've incorporated that here. So we are looking at 350 to 450 basis point rise in the AWPLR. So basically 10% to 11% by June and 11 to 12 half by December is what we are targeting. Exchange rate. So of course, we are again expecting that the currency is more likely than not to be floated, and we are looking at 230 to 245 for June, and a slightly higher range for December, 240 to 270, because of the sort of crisis we are facing, but in a deeper crisis, actually even these rates look a bit optimistic. In terms of the equity market, so real interest rates are at the moment negative, and even if you look at the FD rates, you can see that most of the larger finance companies are offering rates around the 9% mark, but after the policy rate hike, still the rates are around the 9.5%. So below 10%, despite the FD ceiling being at 10.11%, mainly because of the lack of lending opportunities. So we feel that this is going to positively favor the equity markets and even the earnings that are likely to come. So diversified financials, banking, transportation sector, and capital goods are likely to have very strong earnings, and that is likely to that has already improved the valuations positively. So our short-term view is that yes, there is a possibility of a further 10%. We're looking at 15,000 during the first quarter, favored by the negative real interest rates and the lower FD rates. However, something more important to concentrate is on our mid to long-term view, which we've put out in December. So we are looking at a possible economic shock, and we are recommending to aggressively shift to the defensive counter. So we're looking at basically for conservative investors to, if you're in the equity market, then continue to shift into more defensive counters like dollar income companies, banks, life insurance companies, and high dividend yielding companies, because second half of the year could have possibly negative returns in the equity market. And for more conservative investors, I believe equity exposure should be reduced even further to about 25%. So basically, this is graphically illustrating what we are expecting, a rise in the market during the first quarter, and then more importantly, a possible negative return during the second half of the year. So let's look at what can prevent our expectations. So basically, another shock to the system actually could worsen our expectations or our view. And if you look at the second scenario, where now even USD 2 to 3 billion, I believe we may not be enough to correct the current situation. So basically, it may reverse some sort of the short-term view that we have. But a larger inflow and possibly a strong external sector and could actually overall change our or reverse our view that we have presented. So with that we come to the end of our presentation. So we like to highlight to the investors that we are in a crisis situation, and the time is actually running out, and it is important in this kind of even crisis situation to understand the situation and look out for possible opportunities as investors. So that's it from my side, and I would like to hand over proceedings to Vidushika to take things forward. Over to you, Vidushika.
Thank you, Dimanta and Hirani, for that insightful presentation. Let us now move on to another more interesting segment, which is the panel discussion on the overall economic outlook. We are honored to have with us a very distinguished pair of economic experts, Dr. Roshan Pereira and Dr. Nishan Dimel, who will be joining in for the discussion to share their expertise. Dr. Roshan Pereira was a director at the Central Bank of Sri Lanka and presently is a senior research fellow at the Advocata Institute. She served on the boards of the Institute of Policy Studies and the Sri Lanka Institute of Directors, and currently functions as a director on the boards of Union Bank PLC and Senkadagala Finance PLC. Our next economic expert, Dr. Nishan Dimel, is the executive director and head of research of Verite Research, a think tank that provides analytical research and advisory services on economic, political, and legal issues in Sri Lanka and Asia. Dilshan Veerasekara, Director CEO of First Capital, will play the role of the moderator for today's panel discussion. Before I hand over the proceedings, I would like to remind the audience that you can post your questions regarding this topic on the Q&A section of the Zoom app, or if you are joining via our Facebook Live, you can post your questions on the comment section. Now, I would like to hand over the proceedings to Mr. Dilshan Veerasekara to commence the panel discussion. Dilshan, over to you.
Thank you, Vidushika, and thank you, Dimanta Ahiruni, for that presentation. A warm welcome to Dr. Dimel and Dr. Pereira for joining us. Thank you so much for your time. Let's get into things. I know Dr. Dimel has to rush off in about a half an hour, so we'll try to get the most of him while he's here. I'm going to start off with a sort of a common question to both of you. I don't know whether you were listening throughout the First Capital Outlook, but I'd just like to get your views on how you see 2022 panning out, and specifically if you could just give maybe your forecast into growth, GDP growth, inflation, and the exchange rate outlook, so that we can put things in perspective with what Dimanta had forecasted. And just to remind you, Dimanta's forecast for growth was a 0.5% to a negative 1.5% for the year 2022. Inflation peaking at 14.5% mid-year, but averaging double-digit closer towards 12 for 2022. And he gave an exchange rate forecast of a range of 240 to 270. So if I may first call upon Nishan, you to just very quickly give a brief of how you see 2022 in terms of outlook for you.
Yeah. Hi, Dinesh. Thank you so much for inviting us, Dilshan, and for First Capital for hosting this event. Just to very quickly say, we don't have forecasts, I would think, that matches Dimanta's work and effort. Perhaps we will have them in the future, but let me just comment in general. I think that Dimanta's forecast on growth being suppressed is, of course, on the basis that there continues to be difficulties in imports, in forex shortages, and I see the sensibility of taking into account the tightening of this access situation in terms of raw material supplies for the economy, and that having a negative impact back on growth. I also see the sensibility of talking about double-digit inflation. And I think part of it, of course, you could say we took a lot of inflation this year. So we are working off a high base, including the cost of fuel, etc. But I think the increasing interest rates, the accommodation of government spending by the central bank through various means does still suggest with the unofficial rate on the foreign exchange and the shortage of supplies of goods, that inflation can still be driven by those factors. So I think, again, that's a fair assessment that Dimanta has made. And I think the fact that interest rates are under pressure now, mainly as a reversal from the external sector pressures that are coming into the local economy, I think is also fair.
Thank you, Nishan. Dr. Pereira, if I may go to you to also just give your view for 2022.
Yeah, so just to add to that, I also don't do sort of point forecasts like that, but I can just give you some indicators or pointers to where growth are the three indicators or metrics you highlighted. So basically GDP growth, I think we know the domestic situation, but I also would like to highlight recently the IMF also put out their in the World Economic Outlook, the recent forecast for global growth, and that they have also downgraded global growth, and particularly for the US and China. And I think given the links we have in terms of China, US being one of our biggest export markets and China being, one of the biggest import markets, really, or the suppliers, really, we need to be mindful of what impact that will have on growth in Sri Lanka. So that I would say are negatives on the growth side. On the inflation side, I would say I think demand pressures may ease because particularly the central bank has now started raising interest rates and we expect that to increase. hopefully the fiscal also will start trading in, and the central bank will not continue to be monetizing the deficit, but that is still to be seen. But I think we'll also see on the supply side adjustments in prices, because particularly on the fuel adjustment, there has to be some kind of fuel adjustment of prices, particularly energy and fuel. So that will feed into all other prices. And also we're seeing an increase in world commodity prices. And the supply side issues, the supply chain disruption. So how that will affect inflation, I think, needs to be also taken into consideration. On the exchange rate front, I think Nishant rightly mentioned all the things that will happen. So the trade balance basically is widening despite all the import controls. Other current inflows are basically, we're not seeing those inflows. And I think, as I mentioned, basically financial inflows are going to way less than our financial outflows at the moment. So we really can't see anything positive on the exchange rate front. There will have to be a depreciation, and when that adjustment takes place, it's probably going to be quite large.
Thank you, Doctor. Thank you very much. Nishan, back to you quickly. The question that we've got is that obviously Sri Lanka has faced many crises before. I think if you look at from the civil conflict, tsunami, to a global crisis in 2008-9, where we again saw reserves drop close upon $1 billion. Political events, the April bombings, now COVID. However, we seem to be fairly resilient as a nation, and previous crises have been overcome. The question to you is, what type of a crisis is this? Is this worse than the ones we've seen before? And what is really needed for us to get out of it? I mean, is it only a liquidity issue? Would $2-3 billion of inflows fix the problem, or is there a bigger issue that we need to be aware of? That's the question to you, Nishan.
Yeah, thank you, Dilshan. So let me try and answer this core question. Is it only a liquidity issue? And how do we compare this crisis to the past? So I'm very sympathetic to the sense that Sri Lanka has been resilient and has come out of crises before. In fact, if you asked me about a year ago, I would describe Sri Lanka's situation like Douglas Adams' book called Hitchhiker's Guide to the Universe has this restaurant at the end of the universe. You get to the brink of the end of the universe, but you pull back all the time. So we never really fall off. And I think that's what we're accustomed to. But there are four very important variables that look today very different to how they've looked in the past. Okay, and I think that is the reason to think that perhaps this situation is a bit different. I'll just demonstrate them by just sharing a few slides with you, and I'll go through four things that today look different from how it has looked in the past, which makes us want to rethink the situation differently. You can see my slides. Am I right?
We can.
Yeah. The first is what's happened to Sri Lanka in the financial markets. The ratings at CCC that you can see has never been as low as this. But more importantly, ever since we fell into B- CCC territory, we are locked out of international markets. So people talk about, getting into a blacklist, etc. Now that has already happened. Because effectively Sri Lanka can't borrow in international financial markets, which is why you see the other line there is reserves. That reserves have been coming down speedily as we continue to settle international debt, right? So in the past, of course, we settled debt also, but the reserves didn't come down because we could borrow and maintain a certain equilibrium. So the new situation today that's different from the past is that the ratings have already, in a way, blacklisted Sri Lanka. Ratings keep coming down even as we pay, and especially as we pay and reserves come down, the ratings come down even more. So that is sort of a new situation. the reserves that we have today is the lowest we have seen in Sri Lanka's post-independence history. Even at the end of last year, it was just 1 month, and only in 1975 did we see reserves as low as that. Today, it's even lower. I'm talking about usable reserves, what we can use for exports, for settling debt. And in that sense, also, I think we are in an unprecedented moment in history, right? The third issue, and actually the net foreign assets, which is what you really look at, not just reserves, they're in the negative territory. We've never been in the negative territory since 1995 when data is available. Okay, so these are both unprecedented situations for the country. The third unprecedented situation is interest cost as a percentage of government revenue. It's 71%. It's never been so high. In fact, the only country in the world also, this might be at a record level. The country we know that had this rate a year before Sri Lanka did, Sri Lanka had this in 2021. In 2020, it was Lebanon. It proved to be unsustainable. So this is another reason. Now, the other two may have looked like liquidity issues to you, but here's where the issue becomes more about solvency also, when your interest costs are so high. And you can see that debt to GDP in the last 2 years has effectively increased by 25%. Now, I'm not just counting central government debt, I'm counting central government debt and what is all sovereign debt that is effectively also kept in state-owned enterprises. Only guaranteed debt in state-owned enterprises is counted. The 2021 end is a projection, but it should be very close to what comes out correctly. So, when your debt to GDP gallops up by 25% in 2 years, that's hard to think of it as a liquidity problem. And the reason that it is galloping up really is to do with interest costs. So even in 2014 to 19, what this article we published, what you see is that while debt, the total stock of debt rose 42%, 89.8, so let's say 90% of that increase was simply to service interest on accumulated debt. So that situation is not going to change, right? And really the accumulated debt at this interest cost is really what's feeding back into a problem that doesn't look anymore like simply a liquidity problem, but also a solvency, a debt sustainability problem, let's put it that way, for Sri Lanka that is very serious. Yeah.
Thank you. Thank you, Nishan.
Yeah.
Thank you. Nishan, I'm going to stay with you. You've been sort of quoted in the media quite a lot in terms of proposing that the government should default on its debt obligations, or at least on the ISBs, highlighting the fact that having those as reserves is far more important for the country and its citizens to meet essential inputs versus a clean track record of servicing debt. Could you just, for our benefit, illustrate the logic behind your thinking and why you say that?
Sure. No, great question. Let me just say, when we use the word default, we use it in the way IMF uses it, and sort of a lot of people use it differently, especially in the investment banking arena, I think. That is that whenever you renege on any promise that you made to your creditors, so when the creditors are forced to take a lower net present value than you promised them at the beginning of the contract, that is a default, right? So sometimes, but actually it's not only the lower net present value, sometimes if you give them wrong information, also that's called a default. So there's a whole spectrum of default. But sometimes if you have negotiated it, you can change the contracts, but IMF still considers it a substantive default because you can only change the contracts by threat of non-payment, right? Nobody's going to change and accept a lower value unless there's a risk of you not paying at all. So all these are forms of default. So what's important is not, I think a lot of people agree there should be a restructure. Effectively, they're agreeing there should be a default. But I think that the understanding that we want to establish is between two types of default, what we call a preemptive, orderly default, and you can call it a restructure, moratorium, whatever you like, in which you're in control of the situation. right? And you still have reserves. You are initiating a negotiation. The other kind of default that happens is where you're not in control. It's a disorderly process. So it's a forced default. So when your reserves come so low, that you are so desperate that you either have to decide between keeping your lights on or switching your lights off for 24 hours or paying your debt, and you decide to not pay your debt, and this happens to countries. That's what you call a disorderly or forced outcome. So as we've said for a long time, this forced outcome and the disorderly outcome is really the worst of all scenarios, because you lose your negotiating, bargaining power in that situation. Whereas an orderly process, a preemptive process, an early process gives the country a best chance to resolve their problems better. So I think the principle in going for an early process is also, I can share a slide with you just to show that it's very important in these scenarios to share the pain. Okay, that the country is going through some significant pain because of the lack of reserves and the lack of ability to both pay the debt as well as meet essential imports for the country. So for instance, we have 1.5 billion in ISB payments this year. And this is a kind of mapping of what that could have bought or could buy for Sri Lanka, right? 3 years of fruits and vegetables, 4 years of dairy products, 4 years of wheat and maize, 2 years of medical and pharmaceuticals, 5 months of fuel, 4 years of fertilizer. So all these things are actually essential for the country and the economy to function and to be seen as credible in a negotiation. Because when a country goes into kind of an economic nosedive, you lose credibility even in a renegotiation with your creditors, because the creditors ultimately want to see that you've got your economy in control, that you have a path of growth, that you have a path by which you can emerge on the other side successfully in a reasonable amount of time, so that they can also accept a reasonable haircut and come out of it well. The more you keep paying back today's creditors, you leave a smaller pool of creditors with whom you have to share the pain. You shift much of the pain to the local economy and actually put your economy in a worse footing. And you end up actually in a more difficult situation and a more disorderly situation in the future. So I think this is why we have said that the earlier we start this process of an orderly process by suspending debt. So this can be done quite quickly, because what most countries do and have done, and I'll give you examples later, is that they ask for a consent solicitation, you call it, to say, hey, I'm supposed to pay you something in 2 weeks or 3 weeks. Can I consider your payment with the next payment? Because I'm going to initiate a restructuring conversation. Now, when they know that you're in trouble and that if you don't pay them, that the secondary market value of what their holdings will go down, they tend to agree. And that's what's happened in lots of countries. So you've got to be smart about this, right? All restructuring comes with sort of some threat of non-payment, which is why the IMF actually has supported a country's ability to do that. In the 1980s, the IMF wouldn't lend into arrears, which means that if you had already not made a payment, you couldn't get IMF funding. That really strengthened the hands of creditors, because then they knew if they didn't agree to a delay, that you were locked out of the IMF and they had the bargaining power. IMF realized this and said, no, we can lend into arrears. So even if you don't pay and the creditors have not been reasonable to you, we can lend to you. And then the creditors' bargaining power went down, and now they are more likely to agree when you come and say this. So, there's a long history by which countries have been equipped with the IMF also to handle this better to their advantage when they're in a position like this. I mean, creditors who lend to countries like Sri Lanka ask for interest rates of 6, 7, 8%, sometimes 9, 10. The risk-free rate that they get on US bonds is 1%, sometimes less, sometimes 2%. So when you take a risk, you must be prepared for the consequences of that risk. And that's what the IMF also says. So creditors, when they realize that a country has to probably delay payments, are supposed to understand that that's the risk return consequence that they took. And that is why it is possible, I think, to ask for a debt postponement a moratorium on a suspension of capital payments and negotiate an orderly restructure that then reduces the pain on the Sri Lankan economy, shares the pain with a larger number of creditors rather than a smaller number of creditors. So it's an easier negotiation, because if you have to create a lot of pain for a small number of creditors, that's a harder negotiation. If you can spread the pain amongst creditors, that's an easier negotiation. And that gives Sri Lanka a better chance of coming out of this process more quickly, and for the economy also to have less damage in the process. That's my answer.
Thank you, Nishan, for that clarification. Thank you very much. So I'm going to move on to Dr. Roshan Pereira, who was also a former central banker. And we've seen the rating agencies, we were talking about downgrades. We know we've had multiple downgrades over the last couple of years because of the continuing the deterioration of the country's credit profile. However, we've at every juncture seen the government and even the central bank sort of give their view on that downgrade, saying that they don't see a reason for the downgrade, and that essentially disputing the rationale for that downgrade. So can I just get your perspective? I mean, of these two sides of it, do you think the rating agency has been fair by the country, or is there really merit in what central bank says that maybe the rating agencies have not looked at certain aspects, and is there a case for central bank to really dispute the rationales that have come out? Would like to know your perspective, Dr. Pereira.
Yeah, thank you. I think it's not unusual for countries to sort of complain when a rating agency, or for that matter, any international agency gives a negative view on their economy or the country, and I think we've seen that in many other instances as well. But what I would like to say is, I mean, when you look at the rating agencies themselves, they use some kind of framework or a model on which they, based on which they make these assessments. So, and it covers, it's sort of multiple composite indicators. It's not just one criteria that they use. So if there is any sort of issue with these criteria, I think rather than say it's unwarranted or whatever language they use, I think it would be useful for the country to actually specify in what areas they feel that the assessment is not correct. So I mean, just to give you an indication of what kind of indicators they use, they look at the economic growth, and just like we did today, they look at the public finances, because that is one very important indicator for rating agencies in terms of sovereign rating. They look at the external financial situation, the exchange rate management. I think all these indicators, the political risk, the state of the political risk, as well as the institutions. And I think all those indicators are some things that you looked at today, right, in your assessment as well. So it's the same. I mean, a rating agency looks at similar indicators that even a company would look at in terms of their investments. What we have to bear in mind is these are kind of forward-looking indicators. They're not looking back. So I know the central bank, and often they say, okay, we have never defaulted on our debt. We have always paid that our debt. So why are they, why are they, and we are going to pay, the next installment. So why are they downgrading us? But it's not only your past history, but it's also looking at, your future ability in terms of all these indicators. And I think we need to understand the role that these credit rating agencies play in the financial markets, because what they do is basically they are acting as an intermediary in terms of the information asymmetry that exists between lenders and investors on one side, and also the issuers on the other side. And these rating agencies actually help governments like in Sri Lanka to raise capital in international financial markets, with a lot of investors can't put in the resources to monitor or to analyze the situation in this country. So in a sense, they do play an important role, and also they act as kind of they give a kind of a incentive for countries to put their economies in order to to conduct their policies in a prudent monetary and fiscal policy. So I think countries need to pay attention to these ratings because it affects the cost of finance. As Nishan said, as soon as we were downgraded to CCC, I mean, we basically, or CAA, depending on which rating agency you look at, we basically lost access to international markets. So it has a huge impact in terms of countries like ours, access to international markets. So I think rather than criticize these agencies, I think it's good for countries to pay attention. It's not that we only do it because of the rating, but rather consider the factors that affect investor sentiment, because this is not just the rating agencies versus the countries. Basically, this is what investors are thinking and feeling, and it affects investor sentiment. So that's what I would say in terms of the rating that we see and how to really analyze these ratings that rating agencies give countries.
Thank you very much, Dr. Roshan Perra. Another question directed to you by our audience. The question is, what size of a relief package is required from the IMF, if so? Or is it only a debt rescheduling that is required for the country? Given the magnitude of the crisis, how should the government plan out economic activities in the future if they do so go for an IMF program? That question is to you, Dr. Perra.
Yeah, so if you look at the past IMF programs, basically what the IMF does is actually they do an assessment of the country. Right? So they do a macroeconomic assessment, but they also do a debt sustainability assessment, because just like any bank, before they lend, they have to make sure that the country is able to repay that debt, because they are lending as well, right? Though the magnitude may not be as large, they are actually doing some lending. So they do a debt sustainability analysis. In the past, I mean, when they've done that analysis, I think though they have, highlighted issues in the fiscal, in the monetary and exchange rate, external sector, as well as in the debt sustainability. In the past, I think through a fiscal consolidation program, some kind of exchange rate adjustment, and sometimes even the financial sector having some, strengthening of the financial sector, we have been able to negotiate a kind of a agreement with the IMF for a lending program or a adjustment program in the past. But I think this time it is different. And why I say this time is different, because I think any debt sustainability analysis, I think that Nishan very clearly showed us the debt situation. It's clearly unsustainable. So without a debt restructuring primarily, I don't think we can go into the rest of the IMF program. But this debt restructuring on its own is not enough. You've got to have that. Plus, you've got to have some kind of macro stabilization program. You have to have some growth. You have to basically have some kind of structural adjustments or structural reform program to kickstart growth. So I don't think you can have one without the other. They're both necessary. In terms of magnitude, that assessment will have to be done with the authorities, because we're really not privy to what are all the outflows. We only know, the sort of predetermined outflows that the central bank has given, but the economy has so much more payments that need to be made. So that assessment will have to be done with the authorities. But what I'd say is it's not just debt restructuring. It has to be combined with a micro stabilization program as well as a structural reform program in order to ensure that growth is also stimulated.
Thank you, Doctor. Thank you very much for that. Nishan, back to you. I know you have probably another 5-10 minutes maximum with us. So this question goes out to you. Import restrictions have been there now for over a year, and possibly is going to remain in the foreseeable future. What do you think is the economic impact of this self-imposed import restrictions? There may be two sides to it. Also, you might have the negatives. You may have some positives. Would like to know your perspective on the implications of having prolonged import restrictions in the country.
So I think that's quite, I mean, it's an important thing to estimate, Dirshan. I don't think we have done a firm estimation of that, okay? What we do see currently is that there is a huge trade-off between continuing to pay or meet debt obligations in a timely way and being able to supply the economy with essential goods that it needs to function and to grow. So I think if this path continues, you're going to see an exacerbation of those problems. I think we've seen that there are risks of power cuts, we've seen risks of pharmaceuticals, but more than that, especially small producers are finding it harder and harder to source basic things that they need. Because all the features of being blacklisted exist, right? The banks have maxed out on the credit they can get on foreign exchange, so banks are unable to meet actually the commitments of LCs they have already opened. So things are sitting in ports, foreign suppliers are not paid. That scars the economy and scars businesses for a long time, because people will find workarounds. They will find ways to exit the Sri Lankan economy, not work with Sri Lankan businesses. And these have longer term consequences, right? So actually allowing these consequences to continue day by day, week by week, adds to the long-term damage of the economy. So it's very much like, we knew that that the organic fertilizer policy wasn't going to succeed, that the longer the farmers were without the right fertilizer, the bigger the problem would become. And it was snowballing. We couldn't quantify it. But I think if we look at it the same way, we can see that the longer Sri Lanka takes to get into a restructuring path with its debt. The IMF has a famous maxim to describe countries in this situation. They say too little, too late. That Sri Lanka is in real risk of acting too late, and even when it acts of doing too little, treating the problem too lightly, not taking the proper measures to build confidence, to have a plan. So I heard you ask about, why don't we go to the IMF? What can the IMF do to help? In reality, I think the IMF now for some time has been clear that it is not able to lend to Sri Lanka if Sri Lanka is continuing to service the debt, because they don't want their money to go to creditors in Wall Street, as it were. It's a euphemism. But IMF certainly isn't in the business of bailing out creditors who have taken a risk, lent money to make money. And so the IMF will require Sri Lanka to show a credible path out of this situation before you can unlock IMF funding. So IMF is not the solution. There's no IMF solution in that sense. It's part of a solution. Sri Lanka has to have a plan. Sri Lanka has to build confidence and trust. It has to do this early so that it can manage that in an orderly way and not go into real trouble. I want to just end by showing you, maybe with my slides, 2 examples of countries very recently, and slightly different examples who've taken this path and yet managed it successfully. These are not, in a way, highly sophisticated countries. So one is Ecuador. I've used this many times, but I can use Ukraine, Jamaica. There are many like this, where, and this is because it's so recent, in 2020, in March, they started debt restructuring talks. And again, what you do immediately is you see a payment coming, you do a consent solicitation, say, can I delay considering this payment? Usually you get a yes if you do that right. And you start the talks. Of course, they had gone into B- territory already. And when they at the time of starting the talks, they got downgraded some more. But if you're locked out of capital markets, this has the marginal consequence is low, right? As you continue the talks, you get into restricted default or selective default category. And that's inevitable because people see this talk still ongoing. But again, the consequences were not high for the country in doing that. And it had already got debtors to agree to delay payments. Within 6 months, they ended debt restructuring talks, came back into B-, and then soon, a little later, got access to capital markets, right? So that's the path. A 6-month road, which Sri Lanka could have also done last year, in fact, and taken the same road and then got back. Getting access to capital markets is a critical aspect. Because You've got to get your ratings up to get access to capital markets, and you've got to get your reserves up. And I think even the central bank governor's roadmap has those two things. He wanted 4 months of reserves and ratings upgrade. But what you can see is, since the roadmap is put out, that the reality is the other way around. The reserves keep falling and the ratings keep falling, because I think we've got the wrong goals or methods to actually achieve those very correctly articulated outcomes, right? Whereas the method that we saw Ecuador and many other countries follow is actually to dive into a restructure, come out of it in 6 months. Argentina is my second example, and I'm sorry, Dilshan, that I may leave after this. They managed this in 4 months. Okay, so moment they got into kind of much lower, they got into CC rating, like Sri Lanka is in now. They formally requested rescheduling of its debt with the Paris Club, so started the talks and initiated the process. Now they got their capital rescheduled, but they actually, or basically asked for deferment of capital, but were going to pay interest. But they even couldn't pay interest at some point. So they like Sri Lanka in a way, started too late. So they kind of got into a forced non-payment because they were in so much difficulty. So then at that point, they fell into RD, but still they finished the talks in 4 months, got a restructuring plan in place, got back into CCC, which was better than the CC they were in even in 2019, and a little later got back access to capital markets. So this shows how a restructuring talk, well managed, and even when you get into it late, if you really go at it properly, that you can come out of it quickly and get your economy back working quickly, because the moment you get back access to capital markets, you can fix that equilibrium problem I told you that's driving down reserves. You can put in enough money to actually service the capital you repay. You have also given investors and creditors confidence that you have a sustainable plan. And the reason to have the IMF on your side, I think, are two reasons. It's not the solution, it is a solution. One is that the IMF can give you bridge financing. So your reserves have been run so low, you can't get fuel, you can't get pharmaceuticals. The IMF can give you money, provided you're not taking it and repaying your debt creditors. Right? That's very important. So you have to be in this process to get the IMF help. Secondly, the IMF is a conduit of trust, or a trust broker. So if they say, we accept this country's plan, we think it's good, then creditors are also able to have more confidence. IMF can also strong arm the creditors a little. When the IMF says, look, you've got to take a deeper haircut, and that's what they did for Argentina. I mean, they told some creditors, you've got to take perpetuities, that you'll never get your capital back. But when the IMF asks for that, it's hard for creditors to back off. So they can really strengthen your negotiating position with creditors. And that's also very valuable. People who try to do it without the IMF end up giving too little pain to creditors and too much pain to the economy. The IMF can help you rebalance that with credibility and with the sort of institutional muscle that they have. So those are the reasons, I think, that they can cushion your fall, and they can strengthen your ability to shift the pain to creditors and complete negotiations fast and come out of the process quickly, which is what Sri Lanka desperately needs to do, I think, as soon as possible, because we must learn from the fertilizer subsidy situation that the later we act, the more the pain will be on the economy. Thank you, Dilshan. Yeah.
Thank you, Nishan. Thank you very much for that. And I know you may have to leave. Now we have, I think, 5 minutes left. And one last question I would like to direct to Dr. Roshan Pereira. It's on inflation. So much has been said that the money printing or modern monetary theory has seen an influx of cash into the system. However, there's an argument also that the current rise in inflation is not to do with a demand-driven aspect of it, but it's to do with supply shortages. So how do you really address inflation if that's the case? So on the one side, the government is sort of having its hands tied and has to resort to printing some level of money because their revenue streams have declined. So that obviously is fueling inflation more. But on the other side, you have supply side shocks, and that is also impacting inflation. So how do you really get about this double whammy, so to speak, Doctor?
Yes, so I think this modern monetary theory was kind of used at the beginning of the pandemic, and soon after the economy was sort of contracting. And I think there is some validity in the argument if you know the entire demand in the economy is sort of declining. But of course, the caveat is governments need to have the fiscal space to be able to do this money printing. Because we saw this, quantitative easing is basically a similar concept, right? Where the central banks around the world basically infuse so much into the economy. And the difference is basically in those countries that did that. So basically UK, US, Japan, and this is the argument that is brought in very often. If they can, print money and they can do quantitative easing, why not Sri Lanka? But the difference is, of course, those are reserve currencies. Their currencies don't necessarily only circulate in their economies, right? A lot of it circulates outside. We use dollars. Dollars is a very widely circulated currency. So even though they might print a certain amount of dollars, it doesn't necessarily all circulate in that country, resulting in increasing demand in their currencies. For Sri Lanka, the situation is very different, right? We are not a reserve currency, so any rupee that is printed circulates within the country, and as a result, it would obviously increase the demand for goods and services. And the problem here is it's not only goods and services that are produced within the country, it also ends up fueling imports. And that's what we were seeing, is it has an external impact as well, because your trade balance starts deteriorating, and it affects all your balance of payments and your external stability. So I think that's where the problem lies. For those who say that it doesn't have a problem, or it's not just only demand-driven inflation, it's supply-side inflation. Yes, that's true. I mean, Sri Lanka, I think it is both, but the inflation we're seeing now, I mean, we haven't seen inflation at these levels since something like 2009, which is like the height of the war. We haven't seen this kind of double-digit inflation levels. And I don't think it's necessarily only because of the supply side. It is definitely also driven by demand-side inflation. And why I say that is you can look at any of the countries that we talked about, the UK and US. They are all talking about reversing their quantitative easing, right? So they've already talked about that, as well as raising rates. So even though they say yes, they have had supply side disruptions, they are acknowledging that part of the increase in inflation, and they're having like 30-year, 40-year historic highs of inflation, is partly due to demand pressures created by excessive monetary stimulus. So I don't think we can say it isn't. That is definitely a part of it. But unfortunately for us, yes, we are also going to face, as I said, further pressures, because we have food shortages, or we're heading for food shortages, primarily because of the whole fertilizer issue. We are going to have price adjustments, as I mentioned earlier, in terms of fuel adjustments and electricity adjustments, because we can't sustain this price, right? Because we are basically supplying energy at below market prices, which basically means that somebody has to take the tab, and that was usually the electricity company, CEB or the CPC. And now they are basically running out of funds to be able to continue financing their supply. So basically, they can't do this in an unlimited way. So they'll have to revise the tariff rates. So finally, what we have to remember is inflation is basically a tax on people. It is a tax, and particularly the poor, because those with means will basically try to hedge, or will have means of hedging against inflation by moving their wealth from cash or to other assets, right? Real estate, equities, whatever. But it really erodes the purchasing power of those who are at the bottom of the pyramid, or the bottom part of society. And it will basically reduce their disposable income. So I think that is the concern that the government needs to have, is yes, this is going to happen, but how are we going to address it? Because we don't want to have, so it could result in social unrest, and that you want to avoid. So I think this whole thing of addressing the bottom of the pyramid in terms of cash transfers, we do have some of the system, but is it adequate? Is it reaching the people who are really affected, who are going to be really affected? I think that is the message that I would like to give, really, because in terms of inflation, I think the policy decisions are being made, but there are still going to be issues that will be beyond our control in a sense, because there are international commodity prices, some adjustments that we have not made will have to be made. Even exchange rate adjustment will have to be made, and that will have an inflationary impact. So I think you need to be able to cushion the bottom part of the segment of the population to be able to manage to live, to basically to have a decent livelihood despite the increase in prices.
Thank you very much, Doctor. Thank you. And with that, we come to the end of the panel discussion for the session one. I would like to extend my thanks to Dr. Roshan Pereira, as well as Dr. Nishan Dimel, who's already signed off for participating in this forum. And with that, I would hand over back to Vidushika to take us to the main sessions. Thank you.
Thank you, Dilshan, and our esteemed panelists for that valuable discussion. With that, we come back to the second half of our agenda, which is the presentation on apparel and textile sector conducted by Hiruni Pereira. Hiruni, over to you.
Yeah, thank you, Vidushika. So let me share my presentation. Yeah, so let's begin with the apparels and textile sector presentation, and our theme is Tale of Resilience. So we know that apparels and textile sector has faced multiple challenges during the last decade, but it has shown a remarkable resilience. So in 2021, it faced challenges from COVID-19 situation, but it bounced back and has recorded a total value of $5 billion for 2021. So these challenges has even kept the sector even much more stronger position and are now capable of handling further challenges in 2022. So with that note, let's begin with our sector report. So our sector report basically comprises of 5 sections, and under first 4, we will begin with our investment case, and under section 5, we will talk about our hot picks in the sector. So moving on to the first investment consideration, rapid growth in the global apparel demand and currency depreciation to favor apparel and textile industry. So we know in the global context, apparel sector has a hit in 2020 and it recorded only 1.5 billion. But with the gradual recovery, it's expected to record a compounded annual growth rate of 9% and reach 2.25 billion by 2025, showing that the demand for the clothing and shoes is on the rise across the world. And out of this growth, the Asian Pacific region is the largest apparel market in the world, consuming 33% of the global demand, while Western Europe is second with the 28% of the demand. And second, recovering consumer demand to affect on the clothing demand. So we know some of the major economies accounts for the large share of the apparel market. So as you can see in the first chart, these are the recoveries that we expect in 2022. So US is one of the major market, accounting for Sri Lanka's about 40% of the exports. And after the pandemic, US witnessed a recovery in their demand, and it has even led to record an inflation of 7%, which surged highest since November 1990. So this has shown that after the pandemic, these major markets have recovered. So moving on to the athleisure. So athleisure is one of the fastest growing trend in the fashion world, and it comprises of the clothing that is made of comfortable and very flexible fabric. So this athleisure has become a clear winner in 2021, with the pandemic and with the increased working from home arrangements, and it has recorded US dollar 248.3 billion in 2020, and it's expected to grow by compounded annual growth rate of 6.5% from 2021 to 2026. So you can see a lot of major global brands like Puma, Lululemon, Nike, and Adidas are competing in this athleisure space. So to produce athleisure wear, they mainly use synthetic fabric. So with that, the demand for the synthetic fabric has risen in the global market. So it has recorded US dollar 1.37 billion in 2021, and is expected to grow with a compounded annual growth rate of 3.2% from 2021 to 2026. So with that, with the increase in demand for the global synthetic fabric market, these manufacturers are expected to significantly benefit. And moving on to the currency depreciation. So we have closed the year with a currency exchange of 200 rupees and 43 cents. And we expect a steep depreciation for the year. So we expect currency to hover in the range of 230 to 245 by June 2020. And also expect a further depreciation of 240 to 270 by December 2022. So this steep currency depreciation is going to benefit the textiles and apparel manufacturers who have a sizable exposure to dollar income. So therefore, textile and apparel manufacturing companies are significantly going to benefit from this steep depreciation in the currency. And moving on to the apparel target. So we know in 2020, the apparel sector took a hit and recorded only 4.4 billion. But in 2021, it bounced back and recorded somewhere close to 5 billion. And for 2025, we have an ambitious target of 8 billion set for 2021. And this is going to favor apparel and fabric manufacturers in Sri Lanka, because as one of the major export earning income, Sri Lanka is going to give a lot of initiatives for the apparel and fabric manufacturers in Sri Lanka. And also this provides tremendous opportunity to cater to the uncatered local demand. So as you can see in this chart, textile and textile article imports for the whole year is somewhere around 2.5 billion, and our textile exports from Sri Lanka is 260, signifying the unmet demand. So local manufacturers such as TJL, NGT, and Heller can capture this market, and they can provide accessories. So this provides a tremendous opportunity to cater to the uncatered local demand. And moving on to the second investment consideration, which is leveraging on the trade shift. So we know with the pandemic scenario and also with the intense US-China trade war, a lot of major fabric and apparel manufacturers are considering moving out of China. So this is called the China +1 strategy. So as you can see in your chart in the right-hand side, this shows the American business sentiment on the Chinese economy. So the optimism has fallen from 81% to 59% over the 4 years, reflecting that American manufacturers are gradually seen to looking out of China. So this definitely favors South Asian countries, like Sri Lanka. So as you can see in this survey, about 85% of the respondents plan to increase their sourcing from Asian countries over the next 2 years. And those countries include India, Bangladesh, Indonesia, Philippines, Vietnam, Cambodia, and definitely Sri Lanka is one of the key benefiters. So in order to capitalize on these shifting trades, Sri Lanka has a higher reputation for ethical sourcing. So in the third point, we are going to discuss about that. And throughout the years, Sri Lankan apparel manufacturers have gained strong reputation for ethical manufacturing. And this is already reflected in our trusted partnership with some of the major global brands like Nike, PVH, and Decathlon, who are very concerned on the ethical and manufacturing process. And also we are using sustainable manufacturing, and this is already reflected with Sri Lanka having world's first eco-friendly garment factory that cut energy in half and water consumption by 70%. And also with Sri Lanka's continuous investment into the renewable energy sources like solar, wind, and hydropower in the manufacturing process. And moving on to the fourth investment consideration, that is cotton. So we know that cotton is one of the key ingredients used in the apparel and fabric manufacturing process. So after the pandemic, with the gradual recovery process, we have seen an escalation in cotton prices, and it has increased even up to 122 rupees, recording 10-year high. So the main reason for the higher cotton prices is the recovery in the demand and also ban on Xinjiang cotton by US. But with the gradual supply, we expect the cotton prices to stabilize, especially in the second half, so benefiting the margin of the apparel and fabric manufacturers. So those are our key investment considerations. And now we move on to our hot picks in the sector. So first is TJ Lanka PLC. So currently it's trading at a price of 54 rupees and 1 cent, and our fair value for FY23 is 75 rupees. So why we consider TJL is because we expect their revenue to grow at a compounded annual growth rate of 34%, mainly led by the capacity expansion in the Indian plant and exploring into new markets, and also with the currency depreciation. And also we expect gradual focus on value-added products like synthetic fabric to enhance their margins in the medium to long term. And our next pick in the sector is Haley's Fabric PLC. So current price is 43 rupees and 70 cents, and our fair value for FY23 is 60 rupees. So why we consider on MGT is, again, we expect their revenue to grow at a compounded annual growth rate of 41% and reach 42 billion, mainly led by their capacity expansion with the acquisition of South Asian Textiles. And latest addition to the sector is the Hella Clothing. So current IPO price is 15 rupees and fair value is 19 rupees. So we expect Hella to significantly benefit with their first mover advantage into the African region. So with that, we come to the end of our presentation. And I like to conclude the presentation with a quote saying that a market downturn doesn't bother us. It's an opportunity to increase our ownership of great companies with great management at good prices. So with that, I like to conclude the presentation. Thank you.
Thank you, Hirni, for that insightful presentation. We have now come to the final segment of today's agenda, which is the panel discussion on the developments of the apparel and textile sector. I would like to take this opportunity to introduce our esteemed panelists representing two major players in the industry, Pubudu De Silva from TJ Lanka and Adam Collins from Hella Clothing, who will be joining in for the discussion to share their insights. Pubudu De Silva is the CEO of TJ Lanka PLC. Pubudu is also the chairman of Fabric and Apparel Accessory Manufacturing Association, the apex body for the fabrics and textile industry in Sri Lanka since 2020 to date. He is also the member of Joint Apparel Association Forum. Adam Collins is the Group Economics and Special Project Lead for Hella Clothing and leads the company's investor relations function. Dimantha Matthew, Head of Research at First Capital, will play the role as the moderator for this panel discussion. Once again, I would like to remind the audience that you can post your questions regarding the apparel sector on the Q&A section of the Zoom app, or if you are joining via Facebook Live, you can post your questions on the comment section. I would now like to hand over the rest of the proceedings to Dimantha. Dimantha, over to you.
Thank you. Thank you, Vidushika. So let's straight away go into the panel discussion, and our two eminent panelists will answer the questions. So I will start off with you, Mr. Pubudu. Despite having a challenging year last year, that is 2021, the apparel industry has shown remarkable resilience. What are some of the factors that are shaping the manufacturing industry?
First of all, I would like to thank First Capital and Dimantha for inviting us. I would like to give some context in the question. So if you look at global apparel market was 1.5 trillion in 2020, and this is expected to be 2.2 billion range in 2025. So there is a considerable growth in overall apparel market. So if you look at in the Sri Lankan context, in 2019, we achieved 5.3 billion US dollars. And in 2020, this came down to 4.1 due to COVID-related reasons. And then 2021, which is last year, January to December period, we achieved 5.1 billion US dollars. So to be exact, it's 5.07, but approximately 5.1. So there are multiple factors and dynamics happened during last year, as well as in the current context. One of the main factors affecting industry is China-US trade war, with something that we all aware of it. And then, we already discussed in the presentation, Xinjiang cotton ban. That is also another factor. And the customers are, especially US customers, are very particular in Xinjiang cotton due to labor-related issues that has been banned. So there is a cotton price increase as a result of that partially. So then the other one is, which in the presentation also highlighted, China plus one strategy. So that is well understood. So that is another, basically customers are looking at alternative locations other than China because of dominating impact. And then the areas that we can work on is increased capacity. We can take scale advantage, economics of scale. Still, if you look at our industry, our country compared to China is very small. We don't have that much of scale advantage, but still we are competitive, and that is how we have capitalizing our market. And then some of the solutions that we have given, for example, like speed solution, things like that, we have given in order to capitalize in the market. We had multiple challenges like logistic related issues. COVID was that was affecting all over other countries as well. So it's not something only to us. And then in the presentation, again discuss about ethical fashion side of it. Ethical, that has become a hot topic. And as you know that Sri Lanka as a destination has ethical sourcing. Our tagline, which JAF has come up, is garments without guilt. So that is for that, actually we have gained the recognition, and to a greater extent we have been living with that. So we have created Made in Sri Lanka as a brand and destination for ethical sourcing. And then compliance and sustainability is another area that all the customers and even vendor partners and textile mills are working on. Circular economy, circular fashion has become a hot topic to reduce in natural resources as well as reduce wastage factors. And then finally, the garments or the apparel are not going into landfill. Instead, it's going for input as another sector or another industry. And also, the manufacturers are focusing on the three-piece bottom line, which is people, planet, and profits. The other important factor is innovation part of it. So regardless of the industry, I think innovation is important to be in the trend. And then as discussing presentation, athleisure segment is key, and that has come up, especially in work from home scenario. So the comfort wear is important. So these factors have changed from pre-COVID to the new era. The technology we can't disregard. Technology is impacting all the industries, even for apparel industry, textile industry, that has changed. And retail world has changed completely from stores to a digital platform due to COVID reasons. So that has become a new trend. All the customers, even though they had their digital platform, that was strengthened further with COVID. And we have seen impressive change in digital platform retailers. So those are some of the factors that which is affecting the apparel industry. And with that, we need to be agile, and we need to work on those changes to move forward Sri Lanka to achieve $8 billion revenue target.
Thanks. Thank you, Pubudu. I will now switch to Adam. Adam, lot of apparel and fabric makers are basically shifting from China, as explained by Pubudu as well. So in terms of Hella, what is your experience, Adam, and is Sri Lanka capable of handling this demand, and what kind of resources do we need to have to take further advantage of this move?
Thanks, Dimanta, and also thanks to First Capital to inviting me on this panel today. So I think just to put some context on it, I think the shift in apparel manufacturing out of China has been underway for some time. Like if you look at the export data, China's apparel exports have been in the decline since about 2013. But it is the case that, you know, issues around Xinjiang cotton and also the pandemic have really accelerated that process. So we are seeing that, and we do see that among our customers, right? But when an apparel brand looks at moving orders out of China, it's looking globally, right, at its requirements. So Sri Lanka is competing, you know, with the usual players in Bangladesh, Vietnam, you know, nearshore players when it's competing for those orders. So in terms of how Sri Lanka itself can stand out, I think for us, I think the real reputation that Sri Lanka has, which Pubudu also mentioned, in terms of sustainable and ethical manufacturing, is really key. Sri Lanka is a really trusted partner for many apparel brands in that space. In addition, Sri Lanka's technical expertise is really well known. So the ability to do relatively complex garments, as opposed to, you know, your more low-cost destinations, which don't have quite those technical capabilities. Those are the strengths on which Sri Lanka really has to play. I think the other point I would point out in terms of how Sri Lanka builds this and how Hella works on building and taking advantage of this is really building strategic relationships with your customers, right? So that's about offering them a kind of, not just a manufacturing solution, you're offering them a lot more in terms of sourcing, and also building out a local supply chain and kind of bringing those supply chain partners is also very important. So that, I mean, the companies like Hella and the other large Sri Lankan apparel manufacturers are also what will draw brands to Sri Lanka. Also provided that we can also offer them multi-country solutions as well. So they will put some orders in Sri Lanka for the products that make sense here. But if we can also, as one of their supplier base, offer them some other options out of Africa, you know, for other different types of products, that also helps us sustain a really strong relationship with that company and ultimately benefit Sri Lanka as well. So there's like a real range of factors, but I think it's all about Sri Lanka playing to its strengths in what is a really globally competitive market.
Thanks a lot, Adam. So something that is significant with Hella is that, Adam, there is a significant presence in Africa, and we've not really seen that kind of exposure from most other Sri Lankan companies. So if I may ask, what is the main strategy behind expanding into the African region, and what are like the challenges that you all had to face in operating in a African country?
Yeah, so Hella is a relatively new player on the block in terms of Sri Lankan apparel companies. And so when it was looking at its first overseas expansion in 2016, the management obviously considered, you know, a range of options, of which the usual suspects were, you know, Bangladesh, India, Vietnam. But if we had went to those countries at that stage, we would have been relative latecomers, right? And we wouldn't necessarily have been able to offer our customers, a kind of new and unique product or value offering in order to capture additional business. So really the decision was taken to, look at that next phase, look at what are the real emerging frontiers in terms of apparel manufacturing, which is where Africa really comes into play. We also saw that by being an early mover into that space, we could build that, expertise in that space and be a trusted partner for, key apparel brands as they look to shift more manufacturing into Africa. And that's definitely something that we've seen borne out in terms of how quickly our business in Africa is growing. So, now 5-6 years in, revenue generated out of our African factories is more or less, is close, just under 50% of our revenue. So it has been a strategy that's been really borne out, I think, for the company. And we do see additional growth and faster growth coming out of Africa as we go forward. In terms of the challenges of manufacturing in Africa, so I think the main ones I would refer to is, there's a host of kind of cultural and kind of situational challenges, which are a bit different to manufacturing in Asia. So in many of our African factories, so when an employee would join HELA, it would be the first time in which they've used a sewing machine, or it's in fact can be the first time in which they've had a formal sector job. So you're really starting at a very base level and building it up from there. So trying to cookie cutter what you're doing in, say, Sri Lanka and taking it to East Africa is not going to work. It's really all about how you cater it to that local culture and situation. That's, I think, something that HELA has been really successful at, and that's why we've been successful in East Africa where others have struggled, is really seeing how to make it and adjust your working practices to those kind of local factors. I think the other thing people will think about in terms of Africa, is a host of, political or economic kind of larger, broader challenges, which of course are there. But I think what I would say, and those are not unusual in terms of emerging apparel sourcing destinations. And the brands are quite used to those. Managing those is all about, having your risk mitigation strategies in place, your contingency plans, so that you can manage those risks because they are kind of always going to be there.
Okay. Thanks a lot, Adam. I would like to switch to Pubudu. Pubudu, now we know TJL has predominantly been a cotton related fabric manufacturer, and now looking at even synthetic fabric manufacturing, and also there's this new trend, obviously the athleisure trend. So what is the reason behind this, and how successful has TJL been in this road path to it? Also, I would like to ask basically to take consideration whether there is the US demand also in this factor.
Yes, actually, we started our synthetic operation in 2014. We started in small. The reason for that is customers are requesting different type of products and programs. There are different programs, and also we work with customer on these different programs. So to cater to customer demand request, we need to work on a different portfolio in different products. So that was the main reason. And the second thing, that was when we started in 2014, it was pretty small. But today, if you take Sri Lanka, we do about 10 to 15% of synthetic from out of Sri Lanka. In addition to that, we are starting synthetic manufacturing in India as well. That is the 20 tons additional capacity. What we have, the infrastructure is dual capable of machinery, which we can use for either cotton or synthetic. So that's a good news. So entire 20 tons, we can convert even for synthetic. The question why we went into synthetic is, if you look at total synthetic buy, in Sri Lanka is about 750 million US dollars. That was in 2020. So in which we produce less than 50 million US dollars locally in Sri Lanka. The balance is imported. So there is a huge opportunity. This is expected to be 900 million in 2 years' time. So that was the reason. And cotton, if you see, even though total fabric and other accessories imports 2.3 billion, the fabric imports was 1.6, in which 1 billion is for cotton and balance 630 is for synthetic. That was in 2020. And the cotton fabric manufacturing also in 1 billion, locally what we produce is 350 million. And balance is imported. So TJ Lanka overall, we do about 120 to 130 million US dollar business. Altogether, this year we will be achieving about 230 to 240 million revenue target. Then, as I said, India equation, the expansion, 20 tons expansion, we will be targeting on certain customers, especially on Uniqlo as a customer, which we have discussed. And the opportunity is getting into ARism and heat tech of some of the programs. So we have already started those programs, and there is a huge opportunity. And also customer demand, we have got into synthetic, and that's the reason.
Okay. Also, Pubudu, there is a question from one of our audience. Now, basically, US is sort of looking at tapering and managing their inflation, which may have an impact on global growth as well. So how does TJL see that in terms of demand? Do you think there could be a slowdown in overall demand? What is your expectation, Pubudu?
It's not that simple to predict, but the trend says it's continuing.
I think there's a connection problem, I guess. So until Pubudu comes back, I think I'll switch to, oh yeah.
Sorry, can you hear me?
Yes, can hear you.
So I think the demand, whatever the issues, there may be temporary setbacks, but that will pick up pretty fast, and we will be back to normal, and the demand will gradually increase.
Okay. So, okay. We have another question. I would like to direct that to Adam. So, Adam, the question is regarding a recent report by Sheffield Hallam University, naming brands and suppliers who are using Siginag cotton, and major Sri Lankan players are mentioned in the report. So, whether there is any strategy to mitigate the negative impact by this report, what methods are taken to prove the cotton is sourced by these two companies are not from this Chinese region? That's the question by the audience.
Yeah, so we have actually, we also are directly in touch with Sheffield Hallam on that report and how we can best understand their findings. But what we do, I mean, the way we tackle this issue, and this has been an issue that is not new, it's been going on for 2 years plus, is we work very closely with our suppliers in terms of ensuring that those kind of issues are not present in our supply chain. And that is a real key requirement of our customers, that we commit to them on that. And we also require that commitment from all our suppliers as well. So it's really about building that partnership. I think ultimately, in many sectors and in apparel, supply chains for something like cotton is very complex. It can go through tens of stages before it ever reaches us, or even like a fabric manufacturer such as Pubudu. So I think there's also a real role for technology in this space in terms of improving traceability, right? And that's something that we're also actively working on. Is there's a number of potential solutions about how you literally trace a cotton thread from the farm in which it's grown straight through to the final garment. So I think those kind of two would be the two key pillars of the strategy.
Okay. Thanks, Adam. So, Pubudu, now we know that there are foreign currency requirements imposed by the central bank. So how does the fabric manufacturing sector coping with these requirements? I mean, we are going through a forex crisis as well. There are a component of imports also required for TGL. How are you all managing the situation, Pubudu?
Currently, we are managing it, but sooner or later, that could be a problem. As you know that we are a US dollar earning companies. So at one point, there was concerns and whether we should be paid in Sri Lankan rupees or USD. And that has been cleared, and clearly we are paying in US dollars. So we are a US dollar company. So this time to time changing of the changes is not healthy, and even though it has been cleared. The second point is all the zones or the apparel zones in Sri Lanka is governed with BOI regulation. So this regulation should not be challenged time to time. So those things, I hope that will be corrected. But certain imports now, for example, local credit lines, banks credit lines, and opening of LC is a challenge with some of the banks. So those things we are taking as part and parcel of the challenges that we are facing. So we need to find out solutions to meet or navigate that and get into the destination that we wanted to be. But I think, yes, it's clearly a challenge. As we speak, we are managing it. I hope that will be resolved and there will be a permanent solution. But listening to the panelists, I don't know how fast that will be resolved. Anyway, it's a challenge, and I hope that exports, the government will take interest to look after export sector, because that is where we get even the dollars that we want. Right, that's one of the main sources. So I hope that will be keep intact.
Thank you, Pubudu. Switching to Adam. Adam, now Hella is coming into an IPO, and one of the key areas that Hella is interested in utilizing its funds is entering into the fabric manufacturing space. So this is something, a new area of business. So we have 3 questions here, Adam. Now, where does Hella prefer to operate in terms of fabric manufacturing, in terms of Sri Lanka and Africa? And then what are the key factors that made Hella basically to decide to come into this space? And does Hella think that they have the capability to be successful in this space, considering that Hella is mostly into apparel manufacturing? Those are the 3 questions, Adam.
Thanks, Dimantha. So I won't quite take them in that order. I'll start with kind of the key factor driving our move into supply chain. And that's really all about supply chain security for us, supply chain resiliency. I mean, that was something that was there pre-pandemic, but sort of post-pandemic and the supply chain disruptions that we've seen in the past year, 18 months, have really driven home the importance of having, you know, greater control over your supply chain, right? And a related fact to that is supply chain localization, about having a local supply chain rather than having to spread it all across the world, because we've seen all the disruption that leaves you vulnerable to. So that's really the key factor driving it, aside from the fact that it is, you know, a generally kind of consistent vertical integration strategy for the business in terms of building value. I think in terms of the location, so 25% of the IPO proceeds are earmarked for an investment in a fabric mill in Sri Lanka. So the reason for that is that we obviously do have a significant fabric requirement in Sri Lanka for our factories here. And in addition to that, given that, as you mentioned, it is a new business area for us, we want to focus on it in our home market and trying to learning the business before we take it to Africa. But taking it to Africa is a medium-term strategy, because as I mentioned, supply chain localization is key, and we can't be continuing to service our African factories out of Asia in terms of supplying them with fabric. So that's a really key kind of medium-term strategy. The rationale is that we start in Sri Lanka and we learn the sector in greater detail before we take it there. In terms of whether we have the expertise to manage that, so it really comes down to the way in which we're approaching this investment. So we'll be as part of a consortium, which will include a technical partner, which will have most of the responsibility for operating the mill. So they will be an experienced fabric mill operator. And so from day-to-day operations, they will have that oversight and expertise, so that we don't necessarily need to learn that entirely. And then what we can bring to the table is kind of that long-term order book, so that they can also plan out in terms of capacity allocations. So that's really how we're balancing that strategy of gaining supply chain security, while also getting into a kind of new business area in a cautious and risk mitigated manner.
Okay. Thank you, Adam, for that explanation. So we are almost coming to the end of this session. I will direct my final questions to both the panelists. So Prabhudev, the final question to you is that, TJ is on a journey to reach USD 300 million. And do you know that there is some sort of expansion also happening in India? So can you explain your overall strategy in achieving that? What type of expansions are you planning here to achieve, and any sort of innovations that you all are planning to move into?
Well, we took almost 13 years to reach up to $100 million mark from the inception, and then next 100 million up to 200 million came in 5 years time with the acquisition of TJ India and TJ Prints. So today we are a $200 million company with a capacity footprint in Sri Lanka 40 tons and India 35 tons, and TJ Prints will be doing about 500 to 600,000 meters. That's a 200 million capacity footprint. And then we started TJ India expansion to add another 20 tons of capacity from 35 tons to 55 tons. That capacity expansion is in progress, and we are at the last stages. So first quarter we will, this quarter we will have, this quarter we will have about 25% of the capacity which we are installing in India. So once we complete the expansion, it will be 55 tons in India and also 40 to 45 tons capacity we have in Sri Lanka, and the outsourced locations that we are working on. Altogether, it will be 100 to 105 tons capacity. So theoretically, we have $300 million footprint in our with the capacity expansions that we have in place. The aspiration was 2022-23 was the aspiration. So as I mentioned earlier, this year we will be in the range of 240 million. That is with very little capacity expansion in place. And once it's in fully operation, I think theoretically we have $300 million capacity. So whether we achieve that or whether we miss it in a small margin doesn't matter because we have capacity, and then we will look beyond that.
Okay. Thanks a lot, Pubudu. I will move to Adam, and my last question to you, Adam, is that there are continuously new trends emerging in every industry. So basically, what are the new emerging trends in the apparel industry that Hella is targeting to take advantage of? And how do you see the competition that with other countries that you're facing?
Yeah, so I think many of the challenges or kind of changes and trends that we're seeing are ones that have been kind of incubating for some time and are now really kind of becoming the pressing ones. I think maybe the first one would be that need for speed that our customers are asking for. Again, that's partly to do with like shortening their supply chain and making their inventory management easier. But we are seeing a real drive towards speed and also to nearshoring. And that is really a big trend that we're seeing, which is why we're as a company, in the process of establishing operations in Egypt, right? So we can give that solution to Europe and North America. So that would probably be the first one. I think the other one really is around building resilience in supply chains, which is really where our supply chain investment strategy is really coming into play. And that will be something that will continue to be key going forward in ensuring that in any location that we're operating in, we have a strong local supply chain, be that with our involvement or without. And that will also be key. And I think probably the final larger point I would make is there is a general move with apparel brands in terms of their sourcing to move away from kind of day-to-day transactional relationships and purely basing their orders on cost. It is becoming a lot more about building strategic relationships with the brand, giving them a variety of solutions that they don't need to go to different players for. That's why having a kind of multi-country origin footprint is a strength. And actually that kind of thing is something that Sri Lankan apparel manufacturers do very well. And so really looking at it globally, I wouldn't identify any particular country that's a real challenger, but it's really how do we have the real champion companies that can offer these solutions for global apparel brands, which brings the orders into Sri Lanka as well.
And the more important question, Adam, so when is Hella going to get listed?
Very soon. So yesterday, the refunds were completed and the allocation basis was announced. So very shortly, the first trading date will be announced as well.
Thank you, Adam. So that comes to the end of our Q&A session. I would like to thank Mr. Pubudu De Silva and also Mr. Adam Collins for taking their time and coming here to basically provide as much as information about the industry and their companies to our investors. And I would like to also thank our audience in the Zoom and also on Facebook Live to being with us for almost 2.5 hours and listening to us. So thank you very much, and that will be the end of our session for today.
Thanks, Dimanta, and thanks First Capital team. Thank you.
Thank you. Thank you.
I'm good.